In this video, we'll be discussing the wheel strategy in detail, and if you're used to the channel, you'll know that you'll be getting all the information you want without any of the fluff. So let's get into it. What is the wheel strategy? It is an option trading strategy consisting of 3 steps. Sell puts, own stock, sell calls, then repeat. The first, and probably most important step, is choosing the right stock for the wheel strategy. Now, there's no golden rule book here, but I do follow a few key metrics. First, I look for a stock that has recently sold off or is nearing a strong support level. Second, I focus on stocks that are consistently profitable, ideally companies in the S&P 500. Third, and most importantly, it needs to be a stock I truly want to own long term. That last point is crucial. If the stock drops 20% or even 50%, you need to be okay with owning it. That's the mindset behind the wheel strategy, owning quality stocks while generating income. Let's jump into an example here. Inside pro tip, do not use Robinhood as your only tool for picking a stock. The charting on here is trash and you'll get nowhere, so please bear with me while we jump over to Moomoo. Now, based on my profile size, I think that Intel would be a perfect fit for the wheel strategy. Why? Well, it's around $20 a stock, and 100 shares would be about 15% of my portfolio. Ideally, you want to be around 10%, but with my risk tolerance, 15% will do fine. Also, if we look at the chart, we can see that it has sold off quite a bit and looks like it's sitting on a key support level. And it's been in the S&P 500 since 1976, so that meets all my requirements for a good pick. Now back over to Robinhood. Now that I know Intel is my pick, let's pull that up. I was actually just exercised on Intel last week, but if you don't already own 100 shares, you'll start by selling cash secured puts. So go to the option chain and make sure that you're on the sell and put tabs. You'll need to determine your trading frequency for this strategy. I personally like to do weeklies, but if you want to be more hands off, you could do monthlies. I would not recommend going more than 45 days out though, as we are primarily trying to profit off the time decay with these cash secured puts. So you want to be in the window when that's eating away at the contract as fast as possible. But again, this is up to your own personal preference, but I'm going to be sticking with the weeklies for this video. Personally, I like to wait for a red day or when the stock is trading down to open my position. Why? Because you can grab more premium and often get a better deal at a cheaper strike price. Now, when it comes to actually picking the strike price, there's a few things to consider. My rule of thumb is for weekly options, I aim for a strike price that pays at least 1% of the collateral. But if I'm selling options about a month out or longer, I try to target closer to 3 to 5% of the collateral. Now, I notice I keep comparing the premiums as a percentage to the collateral. If you're new to options, remember the premium is how much we get paid to open the position, and the collateral is the amount of cash we need to front and able to cover that put option. And that will always be 100 times whatever the strike price is that you pick. So in this case, I'll be going with the 20 strike put. It meets my premium goal and gives me the strike price that I'm comfortable with, and I will need to have $2,000 as collateral to be able to open up this position. Once we fine tune our limit price and the order gets filled, congratulations, you've crossed the first hurdle of the wheel strategy. Now we wait. Remember, the value of this options contract can change while it's in your account. It moves up or down with the stock price. And since it's a short put option, if it goes up in value, it'll show a loss. If it goes down in value, it'll show a profit. But here's the thing, that really doesn't matter for this strategy. Why? Because we got the max profit up front when we open the position, and we aren't planning on closing it early. We're going to let it expire or let it get assigned. Here's how it plays out. If the stock stays above $20 in this case by the closing bell on December 12th, the contract expires worthless and we keep the premium as pure profit. If the stock trades below $20, we get assigned and use our collateral to buy 100 shares at $20 per share, regardless of what Intel's price is at that time. Now, if the contract expires worthless, we rinse and repeat. Keep selling cash secured puts at whatever frequency works for you. This allows you to stack up more and more premium, which is pretty awesome. For example, I'm currently running the wheel strategy on Intel now, and I collected about $300 in premium before I got assigned. Here's something I want to clarify. Some traders like to use the premium they collected as a cost basis adjustment once they're assigned to show that they're not in the red. Personally, I don't like to look at it that way. The premium is just money in my pocket, cash I could use for other investments or whatever I want. Plus, if you're using Robinhood, it doesn't automatically show you that adjusted cost basis unless you're tracking it in a journal. You're not going to see it reflected in your account. The great part about this process is that each time that contract expires, you get a chance to adjust your strike price. You can follow the stock up or down while you're in this phase of the strategy. But eventually, you will get assigned. And that's when we move on to the next step of the wheel strategy. Now we have at least 100 shares. We own 100 shares of Intel, and you can right away start selling covered calls against your newly bought shares. So go on to the option chain and switch to the sell and call tabs. At this point, we're moving on to the next step, selling covered calls. Now, just like with the cash secure puts, there are plenty of ways you can approach this, but here's my advice. Stick with the same time frame you were using for the cash secure puts and wait for a green day or when the stock is trading up to ensure you're getting the most premium and a more favorable strike price. Here's the key. You need to sell a call at a higher strike price than what you bought the stock at. I know that sounds simple, but sometimes the stock may have dropped so far below your cost basis that selling a way out of the money call just doesn't make sense. So what do you do then? Simple. You wait. That's the safest play. You own the stock, and that's exactly what you wanted in the first place, right? There's no need to rush. For example, I was assigned at 22.5 on a put, and right now the stock is trading lower, so I'm waiting. Once the stock climbs back up, I'll use the same thought process as with the puts. I'll sell out of the money calls above my cost basis, targeting a 1 to 5% of the share's value depending on the expiration date. Now, for the sake of this video, let's say we were assigned at that 20 strike put. Once we get a green day, we're going to start selling covered calls. Looking at the option chain, we'll probably go with a 22 or 22.5 strike call, and that gives us a solid premium and keeps us above our cost basis. Now just fine tune your limit price, and once it gets filled, congratulations. You've crossed the second hurdle of the wheel strategy. Now, just like I noted on the put side, the value of this call option is going to be changing while it's sitting in your account. It will decrease and increase with the share price. But again, we don't really care about the day-to-day price movements because we already locked in our premium, which is our max profit. Our goal isn't to close the trade early. We're simply going to let it run to expiration. And the expiration will play out in two different ways. If the stock stays below $22 by the closing bell on expiration day, the contract will expire worthless, and we keep the premium and hold on to our shares. But if the stock trades above $22, we sell our 100 shares at $22 per share. This happens regardless of how high the stock goes, but we are also cashing in the profits from the shares, which in this case, stock had at least a $2 move, so we'll be profiting $200 from the shares alone. But if the call option does expire worthless, we just rinse and repeat. We sell more covered calls at the next expiration date that makes sense, and we will be consistently collecting premiums, stacking up extra income on the shares that we already own. Pretty solid, right? Now, as a summary, if we look at a single full rotation of the wheel strategy, starting with the put option, then getting assigned, and finally selling the covered call, and then getting assigned, we can see the results. $20 from the premium on the put option, $22 from the premium on the covered call, and $200 from the shares being exercised. That brings us to a total of $242 in profit, which is a 12.1% return on investment in just 2 weeks. That's a solid gain. And honestly, this is just scratching the surface of what the wheel strategy can do when executed consistently over time. Hopefully, this was a great introduction to the wheel strategy for you, and it's exciting to see how you could generate consistent income in a relatively short period of time. However, there's always more to learn. The next step in mastering the wheel is understanding how to manage the strategy when the stock behaves differently than you anticipated. For instance, if the stock moves against you or becomes volatile, you might need to adjust by rolling out your covered calls to a later expiration date or even adding additional legs to the strategy, such as a protective put, to help hedge against any potential losses. But that's a deeper topic for another video. For now, just know that with the right approach, the wheel strategy can be a powerful tool in your options trading toolkit. If you found this video helpful, hit that like button, subscribe for more option trading tips, and drop any questions or thoughts you have in the comments below. I'd love to hear how you're applying the wheel strategy, or if there are any challenges you face along the way. Thanks for watching. Happy trading.